Alphabet is down big time on the release of their latest quarterly results. However, is that share price decline warranted? We're going to dig into the segments and sort of talk about what's going on. And so as you guys smash that like button, let me run the intro. What's up, guys, and welcome back to the channel. And this one's a very interesting opportunity, and this is something that I've been watching for a long time. You guys know that I've been interested in buying shares of Google for quite a while. I've just sort of been a bit picky as to when I was going to buy in, and so now we're looking at this might be the right opportunity. And so let's take a look here. So you can see that year to date, Alphabet was largely unscathed for a while, but then of course, as of May and then now into November, the share price really cratered, and so it's down 42%, and it looks like, at least based on the trend here, that it's going lower. None of us thought that Alphabet would go under $100 per share, and it kind of like sort of lagged around with that resistance level a little bit, even peaked a little bit before earnings, and then it just cratered down from just the $100 level all the way down into the $80. And so by the end of the week, if we have a little bit more pessimism, you could see Alphabet trade under $80 per share, which would be absolutely insane. And so the question is, what's actually going on? And you can see that revenue was actually higher year over year, but weaker growth and lower profitability is worrying investors. And so I'm going to talk to you guys about what exactly I'm seeing. Now let's just start with what Alphabet is doing to address its slowing growth and lower profitability. They're saying that they're going to be sharpening their focus and prioritizing on a key set of product and business priorities. They're also making significant improvements to both search and cloud, and they're looking for new ways to monetize YouTube Shorts. And they don't mention it here, but also sort of encourage connected TV viewing. And so they're looking to be responsible here right now and balance this out by investing responsibly for the long term, but protecting the bottom line by being responsive to the economic environment and not necessarily over investing or over hiring, I would say. And you can see this is how the segments performed this past quarter. So Google services grew 2.5%. Google Cloud just smashed it with a 38% increase. Now, I was only forecasting a 20% growth, so this is absolutely phenomenal. There are other bets, it's a small amount, so 15%, whatever. Overall, total revenues are up 6%. Notice the story here, though, that their income as a percentage of revenues in the third quarter of 2021 was 33%. It's now dropped to 25%. So you can see that the gross profit margins, or the income from operation margins, are significantly declining. So overall, it's becoming a less profitable company, at least in the short term, as this pullback continues. And the one thing that's scaring a lot of investors is that the big story here is that YouTube actually went backwards. A lot of us have in our models, including myself, continued growth for YouTube as more and more people, or more and more ad spending dollars, move away from traditional media and move into YouTube ads. And so this is a little concerning that last year they earned $7.2 billion and this year they're earning around 7.1. So it's important to understand exactly what's going on here, and they explain it, and I'll talk about it in a second. And here's their conference call. I dug into it, and so they pointed out a couple of things. The first thing is they said that the pullback on YouTube is because the pullback in spend by some advertisers. And so what are they doing to sort of address this weaker advertiser market? Well, they're looking to use AI to fuel innovation across their ads platforms via insights, automation, and easier to use advertising tools and formats. So I think that's a good start. But specifically, what are you doing for YouTube? And so they're saying that they're going to be focusing on two areas with YouTube that they're going to continue to invest in. The first one is connected TV, which is a hot commodity right now. And then the second one is shorts, which is another hot commodity right now. So with connected TV, what they're saying is that eyeballs keep moving away from traditional TV, and that's totally known. We all know that. And so YouTube has actually reached more viewers during prime time on connected TV than any linear TV networks. And so brands are continuing to take notice of this. And so ad spending for their CTV platform is increasing. Then when it comes to shorts, the biggest challenge for shorts is the monetization of it. And so creators like myself do know that you don't really make a lot of money on shorts. I haven't committed to shorts on my channel. And what they're saying is, as of September, ads on shorts have officially been launched via, and this is the important part, video actions apps, and performance max campaigns. And so effectively what they're doing here is they want to make it so that shorts become actionable. And I actually saw one of these ads for a shoe manufacturer where the shorts video was playing, and right underneath it you could click into the specific shoe that you want to gain more information about or potentially buy. So you can click into these ads. It becomes very actionable. That's a big deal, and I think that makes shorts more valuable, because if you can start getting consumers to buy the products right on that ad, it makes the ad much more valuable. And so now it's more of an action as opposed to brand building, and actions tend to be more valuable for the advertisers and for the advertising mediums like YouTube. Now, Eric Sheridan from Goldman Sachs, he's the analyst who covers Alphabet, asked the management team about more comments on YouTube. Like, is there a potential for growth going forward? Like, can you dig a little bit deeper on what you're seeing in terms of both the opportunity set to drive revenue and turn a possible headwind into a tailwind with respect to shorts and connected TV over the medium to long term? And so this is what the answer was. They reiterated that the pullback in spend by some advertisers across both brand and direct response is the reason why YouTube fell backwards. But they think that there's a lot of room to run to make YouTube more shoppable and more actionable. And that's a very important point, because traditionally YouTube advertising has been very much brand building and not necessarily actionable. And so from video action campaigns to product feeds, app campaigns, to even live commerce like you have in China, advertisers are turning to YouTube to convert intent into action and really drive performance at scale. And like, this is where sort of Instagram or the owner Meta really makes its bank. And so if you can start doing this on YouTube, you're going to win here. And I do believe this is the right strategy. And so they go on to say that on average, video action campaigns with product feeds saw an over 70% increase in conversions on shorts versus those without. So the proof is in the pudding. And so on the brand side, they did say that eyeballs are moving away from linear TV. And so for brand type advertising, connected TV is an important part of that strategy. And so they're going to be continuing to move on to CTV and advertising with YouTube. And so they do believe that YouTube is really the best place for advertisers to reach new consumers across multiple formats. So if you want to build your brand, you can use the traditional advertising means on YouTube, but you can also start using connected TV. And if you want to create actionable type of advertising campaigns, you can do that using shorts now as well. And so I believe that there's a lot of opportunity for YouTube here. And I'm not going to look at the current pullback as a permanent sort of view for this segment. I do believe that YouTube ads continues to grow over the medium to long term. And so I'm going to forecast it that way in my valuation. And speaking of my valuation, this is what the model looks like that the Patreons get access to. You can see that Google search actually grew by 43% in fiscal year 2021. Now for 2022, I'm just forecasting 10% growth and 10% thereafter. For YouTube ads, I'm forecasting 0% growth and then 10% in 2023, so a little bit of an uptick, and then 15% thereafter for the next 5 years. And then, once I build out this model for a 10-year model, I will taper that down. For Google Cloud, I'm expecting 25% growth in 2022. It looks like they're going to surpass that. And then with 2023, I'm bringing that down to 20% and then holding 20% thereafter. And then once I build this model out for 10 years, I'm going to taper that down to 15%. But notice that the 41% growth that you saw in 2021 for revenues, I am not forecasting growth to remain that high. In 2022, I'm forecasting growth to only be at 9.3% and then hover around that 10% thereafter, and then it'll actually come lower thereafter after 2026. And so I'm being somewhat pessimistic in my valuation, but I do expect that reflects reality. Now, based on that and a terminal multiple of 22.5 times earnings, and some of you might argue that might be too high, I'm going to hold strong to that because this is a future-focused market leader, and there's nobody that can challenge Alphabet on many of their businesses, so I'm going to hold to that multiple. I believe that this is one of the most future-focused and important companies, trading for approximately 50% of their intrinsic value. And so this is absolutely a name that's going to end up in my portfolio And so how do I think that I'm going to do that? Some of you might not necessarily want to buy YouTube or Google or Alphabet at approximately $84 per share, which is where it's trading at today. You guys might want to wait until it's 80, 70, or even 65 because you're worried about the share price declining even further. And so I did the work for you here. I'm going to show you the yields for the cash secured puts on these opportunities to see if they actually make any sense. And so I'm using the cash secured puts calculator, which you can download for free from the description below. And so starting with the first one, the $65 strike price for the January 19 cash secured puts, you can generate a premium of $4.75. That will give you an annualized yield of 6%. So that's not really high, but what you do have is a net purchase price as a percentage of the valuation of 37.5%. So it's pretty low, but you're not really getting a high enough annualized yield to justify tying up your money for over a year at 6%. It just doesn't make sense. Moving on to the next one, which is the $70 strike price. The premium that you're generating is $6.25. The annualized yield is 7.37%. So once again, the same story as the previous one. You're just not getting a high enough annualized yield to justify tying up your money for that long. So now let's go to the $80 strike price, which is only $3 per share lower than the current share price. You're getting an annualized yield of 10.06%, and that's with a premium of $9.75 and a strike price of $80. So once again, it's a higher yield, but not enough to justify tying up your money for that long. And so although you get a net purchase price as a percentage of the valuation of 43.7%, sometimes it just makes a lot of sense to buy the shares out flat. And what this is really reflecting is that overall, the low yield of the CSPs are reflecting the fact that investors believe that we are somewhat close to the bottom. This doesn't mean that the shares can't crash further. And in fact, if there's further rate increases or a huge pullback in the consumer, you are likely going to have a crash or continued crash in the share price. But there's likely going to be a ton of support here. And so in these types of situations, it's always just best to buy the shares outright, in my opinion. But once again, this is never advice. Always talk to your advisor. And so this is one of those situations where you could choose to buy now, or you could choose to be very picky and say, hey, listen, I don't want to buy for anything under 50%. The reason why I'm a little bit more on the side of purchasing the shares now, at least for half of my overall position, is because you don't know if the shares will go down a little bit lower. But if you're getting them at approximately 50% of their intrinsic value, it might be a good idea to pull the trigger right now. So that's kind of where I'm sitting. I do believe that there could be a big recession on the horizon, especially with further rate increases. I don't think we're going to have that soft landing. And so we might have one of those situations like we had in March of 2020. That was the last time I was all in on the market. I'm still mostly in cash, and so I have the firepower to deploy. I've just been so conservative with respect to the valuations that I'm looking to buy in at. But this might be one of those where, you know what, enough is enough. It's time to pull the trigger on one of the greatest companies that I do believe exists today and that will exist 20 years from now. I do believe that Alphabet will be around. And so this is just one of those names that I can park money in and then never even have to think about it. I don't have to read the quarterly disclosures on this one. And that's the best type of company. I do believe that they will make more money in the future than they do today. And so it's one of those inevitable type investments where you're going to make money. You just don't know how much. And I do believe that I can make around 10 to 15% a year on this one. And that's all I require for my portfolio. So that's why it's an absolute deployment of capital from my perspective. Now, I recently did talk about Apple and whether or not I think that's a stock worth buying as well. And you can actually get to that video right here.